Welcome to the Daily Update. This is Being Prepared Tuesday, October 4th, where we'll look at the action in the market today and then see how things look for Wednesday, October 5th. And we saw another really solid up day. Of course, we have to ask ourselves, is this still a dead cat bounce, or have things actually started to turn and look a little bit better? I have some thoughts that I'll go through near the end of the video just to give you a scenario that I'm trying to see just how close do we get to something like that happening. With the two solid up days back to back, of course, that's really positive, and everyone's like, the bull market's back, everything's fixed. Yes, here we go. But we've gone up pretty far, pretty fast. And believe it or not, on a short-term basis, there's a few indicators that we have where we're looking a little bit overbought right now. Indicators that just a couple days ago were oversold have been shooting higher, but it is improving the situation overall. What we want to see is what resistance do we have above us? And if we hit that resistance, are we going to come back down? Would it be more to our benefit to have the market actually decline to maybe going sideways a little bit and then see the intensity of especially a decline and then evaluate where things are at before we possibly make another run to the upside? That's kind of the scenario that I'm looking at right now, and I'll back it up with some of the charts that I have to show you. So let's go back and talk about what happened. We had a gap higher at the open. In fact, we gapped above R1 at 37.16. We also gapped above R2 at 37.54. R3 was way into the 38.40s or 50s or something. So we never got even close to that. We didn't even get to the midpoint, which was at about 3,800. When you use a pivot calculator, you calculate the R1, S1, and all those different levels. Well, on the calculator that I use, there's also a midpoint between the different pivot levels. And sometimes I keep an eye on those. They tend to not really come into play. Well, that's kind of about as high as we were able to go in the session on Tuesday. As the day went on, we saw prices continue to climb. They fell back a little bit, and I thought, okay, here we go. Maybe we're going to see more of a pullback now. But no, they came back almost down to R2 and then started climbing again. So is that a short cover rally? Are people just really thinking that maybe we're bouncing? A lot of our scenarios continue to improve. And excuse me with my voice. I apologize for that. I wish I could edit this out, but with this software, I can't do that without starting the whole recording process again. Anyway, but we are looking a little more positive, but maybe we've gone up a little too far, too fast to really be able to sustain this. Going into the close, we closed at the high, and that's a positive thing too. After we fell back and started seeing some more buying, to close right at the high is pretty positive. We were up over 3% with the S&P. And just think about this. We're up 5.65% just in 2 days, just in Monday and Tuesday's sessions. That's a big move. Now, as much as people might really like that, this solid just spike going up, it's going to be hard to justify that given all the headwinds that the market is facing right now. And a lot of our indicators are saying, whoa, we're kind of overdoing it here. But hey, at least we're going up if you're more bullish on the market, if you benefit from things when the market goes up. So that can at least help you feel a little bit better. Volume was still above average, and the technicals are still negative overall because we're just seeing 2 days of improvement, even though it's pretty explosive improvement. But we're still way below any significant moving averages that I follow. I don't have any moving averages charts here. We have to regain them. We're a little bit above a 10-period moving average right now, which I don't have a chart for that. But we haven't gotten back to the 20, the 50, all the different moving averages that we study. Inflation and interest rates, that's still the name of the game when it comes to the stock market. That's what's making things going up and down right now, even though there's a whole list of geopolitical concerns specifically going on in Russia, as they're involved with Russia, Ukraine. There's more rumblings about the pipeline. There's more talk, which right now might be rhetoric. There's a lot of concern that things might escalate because now Ukraine is on the fast track to becoming part of NATO. That might escalate things because if in a true NATO sense, if they join NATO, that is going to force the US into a war, because the idea behind NATO is if one country is attacked, all of NATO is attacked and everybody else comes to help. So that can really cause some concerns as well. And then any Fed speak that we might get. Oh, and I wanted to mention, things seem like they're calming down a bit more in the UK as well. I still have a chart of the British pound, but it looks like, at least in the very short term, that's not the main news story currently. So what are some comments? One thing that did happen, we have this scenario coming out again, that maybe inflation has topped out. It's starting to come down. Maybe the Fed can start to lower or at least slow down with their interest rate hikes. And that's really what the markets are looking for, is this Fed pivot, going from this hawkish stance to a more dovish stance, which is more market friendly. Because look at what they did in Australia. The Reserve Bank of Australia, they raised their rates, but they only raised them 25 basis points, where everybody was expecting it to be 50 basis points. Still pretty low there at 2.6, but still the markets grabbed onto this and went, okay. Because what they said in Australia is that the cash rate has been increased substantially in a short period of time, and they want to take some time to assess that impact prior to a continuation of raising rates. We want to look at inflation and economic growth. And now US investors are starting to adopt this same scenario again, that maybe that's what will happen here too, that, okay, maybe the Fed will still raise interest rates coming up at their next meeting, but maybe not as much as we're thinking they will. We're seeing a lot of economic reports that are coming in weaker than expected, but we're not hearing anything. There's been no official policy pivot yet, especially from Chairperson Powell. For the most part, the people that are on the FOMC, they're sticking to the same scenario that they have been, that we're trying to get ahead of inflation and we're going to keep raising interest rates, and we're going to keep interest rates at a higher level until we see inflation really start to come down, and then we'll worry about the economy after that. The same yield curves that have been inverted continue to be inverted. Sentiment is starting to improve. We're no longer extreme as far as fear is concerned. We're just in the fear area right now, and I'll show you that chart. The S&P, and I have a chart to show you this. I got out an S&P chart and drew some fib lines, and it looks like on a short-term basis, we are at resistance right now, and I'll show that to you. And even in the short term, it's becoming a little overbought, as I mentioned, and I have some charts to show you. Another thing that may be developing is to go up over 5.5% in 2 days. A lot of people who thought, okay, I'm leaving the stock market alone, they're going to maybe develop this FMO. Remember what that means? Fear of missing out. Actually, it should be FOMO, but they don't want to be left behind. They're pretty much convinced, they were convinced that the market's just going to go down, 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 down. Now they see it turning around and going back up in a pretty strong way. If this continues, they may not feel comfortable being on the sidelines, and so they may try to chase some of the bounce that we've been seeing. It doesn't really look like it's happening all that much yet, but it could. And a lot of times that ends up developing right at the point where we get resistance, or we get some statement from Chairperson Powell, or something ends up happening where we're overbought and they get in at that point, and then the market turns and goes the other way. That's how the game tends to play out quite a bit. Another thing that's interesting that gave at least Twitter some support is it looks like Elon Musk is coming back in, and he's going to come back with his original offer price and say, yeah, I think I'll buy this thing after all. So that's kind of making the news rounds right now. As far as the economic reports, we had factory orders that ended up being unchanged on a month-over-month basis, where they had expected them to be up 0.4%. That's weaker than expected. The job openings, they're at 10.053 million. We're coming down a little bit now. That's still a lot of jobs, but the last time we got this report a month ago, we were at 11.23. And if you recall, the month before that, we were in the 12 millions. So we're starting to see a real decrease in the number of job openings right now, ahead of the big employment report coming out on Friday. Our trend, it's negative, but it's starting to weaken. With these two back-to-back up days, the ADX was measuring the downward movement. And since we're shifting right now, the ADX is starting to roll over, but it's still above 20. I still have our bias at positive because we had another up day. I've switched our momentum to mixed, but that's a real tentative mix, more kind of on the negative side of things. To see these two powerful days and to not give anything back would be abnormal. And in fact, right as I started recording, the futures were down about 0.5%. But again, as I record this, that's many hours before the market opens. And the dollar is up where it had been down in Tuesday's session. So we're kind of shifting back, at least in the overnight session. Will that carry through into the open? We don't know. There's still many hours to go. So let's go back and talk about today's session. See how we're just in the fear camp right now. We were able to get back above 25, and we have a current reading of 30. And as we've been coming up, this historical chart has been showing improvement. Here's another look at the overbought, oversold composite. I highlighted this in yellow, where we had come down to not as extreme as we've been before, but this is a pretty extreme reading. Now, this is a few days old, and possibly before we saw Monday and Tuesday's advances. So this is getting more of a contrary look right now and justifying why the market is going higher. Here's another look. Global semiconductors and semiconductor equipment. They're really having some trouble. In the weekly video, I always talk about semiconductors and I show the chart because that's a huge part of tech. What they're showing on this chart, when you compare it, you go back in long term, when we hit a bottom in semiconductors, we were really a lot lower than where we are at right now in the earnings revisions. Things, I guess what they're saying here is things haven't turned bad enough yet for the semiconductors. Again, this might play into it. If you do invest in this particular sector and you know a lot about it, you might know things that this chart is not telling you. But at the same time, are we seeing this across the board right now in other sectors as well? But this is just giving credence to the idea that there might be some more downside to the semiconductor sector, as well as semiconductor equipment. Another chart, we had the ISM manufacturing that came out. And as the purple line is the S&P 500, and it's been going down on a year-over-year basis. Looking at the monthly chart, okay, let me get back to the right chart, where the orange line here, that has also been decreasing. And you see where these have a tendency to move in the same direction with each other. So we're seeing a decrease in ISM manufacturing. Does that suggest that we might see more weakness with stocks? Here's the latest reading. See how we're spiking up here. Remember, there's a couple day lag here. This is the reading as of October 3rd, which is probably based on Friday's data after we had the massive down day. We're really spiking up with those folks that are getting into the bearish mutual funds right now. And when they all start to get going in the same direction at the same time, that's usually when we reverse and go in the other direction. And this chart just kind of points that out as well. This is just a look at the dark blue areas. This is what the Fed has already done as far as raising interest rates. They're still looking at the 75 basis point move at their next meeting in November. And then these are just forecasts for what they think will happen. This is kind of a graphical difference than when I do the Fed Watch tool, especially in the weekly videos, where we just show the percentages of what participants think will happen. And they're still coming up with the idea that by February, we'll top out about 4.5 to 4.75 and be right around the 4.42%. That's just a forecast right now. This could be lowered if things really start to get more negative. This could be raised up because it already has been raised with the problems with inflation. And then it's about 2.5%. This is what they're considering to be the neutral rate. That's where the Fed wants to get back to. Officially, I thought they were at 2%, but this has them at 2.5%. It just depends on where you get your information. This is the tide could turn for the dollar. We've been watching the dollar go up and up and up and up. It hasn't over the last 2 days, but nobody's really believing that these skyrocketing rates for the dollar are going to continue. And so they do see how we've been going up, and they suggest that we might even, I should look at the bottom part here, that we might go up even further right now. But then once this is all over with, the party's ended, that the dollar's just gonna tank, and they're going way down here. Who knows what will really happen? The dollar will be bye-bye. We'll get the, what is that, the Amero, or we might have digital currencies by then, the government version of Bitcoin. That type of thing might be happening into the future, but it's really hard for anyone to really take the dollar seriously right now. But when you compare it to all the other currencies out there, and because it's still the king currency of the planet, at least for the time being, they just think that the future of the dollar is not very bright. All right, then this is saying how real stocks are now cheap when you compare them to the S&P. I don't have a ratio of that chart that I show, but this is just showing how the real estate sector, their PE ratio relative to the S&P PE ratio, this just shows how we are really undervalued right now in the real estate sector itself. Does that justify what we're seeing in the economy with interest rates going up? So mortgages are more difficult to obtain. Housing prices have been going up, but they're starting to come back down. You want to kind of see if this chart actually lines up with other things that are happening. This is the ISM manufacturing prices paid with the CPI, where the green line, this is the manufacturing. And we're going to be getting that report in Wednesday's session. This has really been declining, and they've shifted it by 3 months. They do that great shift thing here. This is suggesting that prices are going to continue coming down. So we want to watch for that report, because if it comes in stronger than expected, it's going to kind of blow this scenario out of the water, and it might produce some more headwinds for the market. Where the white line is the CPI. See how it spiked up and started coming back down? This is when everybody was starting to party until they stopped, because Chairperson Powell came out and said, no, we're not going to do things that way, at least yet. This is the aggregate U.S. equity futures and S&P 500 ratio to its 200-day moving average. And we measure this in a little bit different way, where the blue line are asset managers, where they were extremely bearish, but starting to show some improvement. And the S&P relative to its 200-day moving average, it still has this going down. I'm not really sure why, because we're seeing a bit of an improvement there. So they must be using some different form of measurement for this. But the line that I was paying attention to is the blue line. How a lot of times when this blue line gets to the bottom, that often marks some kind of a bottom in the market. Household allocations to equities. After being up around 45% or so of the households in the US that own or are involved in the stock market, either directly themselves or through some kind of a retirement plan, we're really seeing that coming down. And it's still at 39%, where we have debt. It's actually increasing by 16%, and cash has been going up to 18%. Now, debt could also likely mean bonds as well. Here's how we looked for the day. We did see growth outperform value on a relative basis, as well as for the mid caps, but on the small caps. And the small caps, they're chugging along. They're kind of helping us out. Our mid caps, they're looking a lot better too. They have the best looking chart right now that I'll show you here in just a moment. So we are seeing some improvement here. As we're going up, the VIX is continuing to decline, both with the line chart and with the bar chart. And here's the VIX of the VIX. Since we're coming down, we're seeing a decline with both of these charts as well. The Ulcer Index continues to fall as fear is subsiding somewhat. We're down 21.33% from the all-time high. We're still into that 20% category, at least the way I calculate things. But if we could get up a little bit more, at least we would get out of the official definition of a bear market. We're seeing a real drop in the 1-day chart of the equity put call ratio as the market has been going up. The 5 period is also coming down after giving us a spike. This could provide some support for the S&P because this is a pretty high reading. And we're seeing a bounce after we saw this real spike up. As far as support and resistance, and I have put these on the YouTube channel community page. I'm going to start doing that, even though I didn't get any likes for those. There's a couple people but they like anything that I put up there. But I'm going to do that just so you folks have a chance to see what the pivot levels are. This is the daily chart. So this will just show you the intraday movements that I like to look at while the market is open. And then the other chart just shows us the monthly pivots. They're good for the whole month. Here's the daily chart showing how we were able to get back above this pivot level. And that's pretty positive. And we're moving up nicely right now. We're able to get back above 3,700, which had been acting as resistance on Monday. Well, we just opened and blew that in the dust in Tuesday's session on an increase of above average volume. Here's the other chart that I'm starting to put on the community tab on the YouTube channel. And then this is what I was just playing around with here. I went to the high that was set back in August, down to what potentially could be the low that we set right at the end of September. And I said, okay, well, let's look at this fib retracement here. Well, we're not really hitting anything yet when we go to the August high. But you remember when we hit the moving average and then everything started to tank after that? I tried another fib. Remember, I do these myself and I have to do them freehand here. But when we hit that moving average and really started to come down, that's what I picked for a high. And then I came down to the potential low, and we're right at a 38.2% retracement. This could act as some short-term resistance. Not saying that it will, but to have this solid bar from Monday and then another really strong bar on Tuesday, and then to end right at this level, that's not necessarily a coincidence. So we might have overdone it a little bit in the very short-term basis. On a longer-term basis, we're starting to come back up to these other fib levels that we broke through going down, and I still haven't changed this highlight here. But can we get above that at that level? And then the weekly chart, this is what really seemed to have worked out nicely, at least so far. We came right down to this 200-week moving average. We opened up on Monday, and we've been just going back up ever since. We might get to some more resistance at this 38.2% retracement. That's at about 38.19 or so on the S&P. Then we're coming back up into the middle part of the trend channel. So that's showing some improvement. Our sectors, all the sectors were up, being led by energy, financials, materials, and discretionary had a pretty good day. Staples were up as well, but they performed the least well in Tuesday's session. We still just have one chart, the energy sector, which is in the 99.3 scooter score right now. That's a pretty solid looking chart. You can't really get much higher than that. And we're seeing a real improvement in the energy sector. Utilities are still negative, even though they were more negative. And then all of the other sectors are showing some improvement, but are still quite negative since the all-time high. Here is the updated look at the percentage changes since we did hit that all-time high in the S&P. That's the pink area right here. Our technical alerts, all of them were positive except one. The dollar ended up closing below 110. But all of these, the S&P got above 3,700. We had a BPI cross above 20, and everything else. We're seeing a lot of the negative signals that were generated last week turning around and going back up, and they're starting to generate positive signals this week, not only with indexes, but also with sectors inside of the indexes. Our scores, mid caps, still are leading the way. See how this is really showing a lot of improvement? We're at 68.7. And then in second place, small caps, which had been really suffering, they're showing some improvement too. We have the Dow in third place. It was actually down a little bit. And then the S&P actually declined a little bit on a technical analysis score. And the Qs continue to, they were up 0.1 with their score, but we're going to need to see a lot more follow through for these charts to show some more improvement. Intraday, so here is the gap. We gapped above R1, even went above R2. We shot up here right at about 3,800. This was the midpoint for R3. We kind of did the smokestack look for a while. It looked like we were going to come back down. We did not quite get down to R2. We were able to bounce back up from that and then close right at the high. So that's a pretty solid looking day overall. As far as our trend, because of the upward movements that we're seeing here, we're seeing the ADX start to roll over. It hasn't crossed below the moving average yet. We're seeing the red line coming down and the green line going up, but this is still a negative trend that's above 20. The Arun is showing some improvement as well, as we're seeing a little bit of a decrease in selling, some increase in buying, and so the oscillator is showing improvements. As far as breadth, look at this, just powerhouse. We've had just mass. This was Wednesday, and then Monday and Tuesday, just massive upside thrust that we're seeing right now. And we saw a real expansion with the volume to the upside as well. These are still pretty negative overall, the charts down below based on price and volume, but they are improving. Our advanced decline ratio, after being extreme negative, is showing improvement. The new highs, new lows, even though we're not seeing an expansion of new highs, we are seeing a contraction of new lows, and that's helping our 5 period to turn back up, and our 10 period is starting to turn back up as well. Accumulation distribution, we're just a little bit above a declining moving average, but that is showing improvement. Short term, this is where we're looking a little overextended. We were overextended after Monday. We had a reading right where my cursor is. Well, after Tuesday, we're even more overextended. That's just a 1 day rate of change, comparing 1 day to the next day. Advanced decline ratio, same thing, where we were extreme after Monday session, we're even more extreme after Tuesday session. That might mean that the market is due for some kind of pause. Now, it doesn't necessarily mean that we're going to turn around and go back down. Now, hitting that resistance, that might be what it means, the fib level that I showed earlier. But even if we were to go sideways or even see a small decline without a lot of volume behind it, that could end up being a little bit more positive for the market. And I'll talk more about that later. The rate of change going back 5 periods, we're starting to get extreme. The Stochc RSI, which just a couple days ago was extreme negative, now it's extreme positive. Williams %R is also showing some improvement. The force index, we're zipping up pretty fast, and we're at the upper side of the Keltner channel here. And the STO, or Swindlin Trading Oscillator, this turned out to be a good signal. We saw this turn up after Friday's session, and so far it's been following through that and turning more positive based on price and volume. McClellan Oscillator crossed above 0, so that'll help our summation index to turn up as well. Our 20 period moving average study showing a lot of improvement, as is the 50 and the 200. So they've all come out of being extreme negative currently. So this oversold condition has now been worked off according to this chart. Our stochastics, not extreme positive yet, but showing improvement in the short term, turning up and looking better with the intermediate term, and still extreme negative, but starting to turn up with the long term. Intermediate term, after the Sean trend meter was giving us an extreme negative reading, it is now showing a lot of improvement. Our oscillators, this is happening too fast for many of them. So we're seeing a little bit of a turn up with the PMO also based on price and volume, but it's going to take more than this to shift, even though we have a couple of our oscillators turning positive. But with the PMOs that are rising, we've already shot up to an extreme positive reading. We're turning up from extreme negative with the buy signals and starting to turn up from extreme negative with the PMOs that are above zero. Chaikin oscillator showing improvement. Chaikin money flow also showing improvement. Volume still is above average, so that seems to be rather healthy right now. We're seeing a decrease in selling with the vortex and an increase of buying, but it's still negative overall. Here's where the summation index is just starting to bottom out here, where we've already bottomed and started to turn up with the volume. And the way these calculators work, sometimes the volume indicator is a leading indicator. Here is slope, where it's starting to turn back up, and I have to clear my throat again. That's showing some improvement. The MACD is just about ready to cross. And this is a pretty extreme negative reading right here. When we get a MACD reading this low, where the KST, the tricks, they're longer term. And so it's going to take more for them to really notice what's going on. The PMO is looking a little bit better, as I showed in the other chart. And our TSI has now gone extreme negative and is starting to turn up. So this is really improving here, but we're not seeing across the board positive signals, at least yet. The BPI, after going extreme negative, really shot up. That's a pretty good sign right there. The ease of movement is also showing some improvement. The ultimate oscillator improving. Money flow index, after giving us an extreme negative reading, which we have not received in the last year, this is showing some improvement as well. The boom indicator, and I'm probably going to take this off if we see continued follow through upside movement. After getting really extreme, we've crossed back above when compared to the 50, and we're starting to turn back up compared to the 200-day moving averages. The TTM squeeze is looking a little bit more neutral now, but it's still negative overall. Our balance of power is showing improvement, but still below the dashed line. This is the CMB composite, where we had the first signal when it crossed above the red line. We had a confirmation when it went above the green line, and now this continues to go up. On a trending basis, we're showing kind of a mixed picture right now. The Heikin Ashi, which showed some improvement after yesterday, showing even more improvement currently. And we switch back to black with the Kegi chart, but our Renko is still negative. 3-line break, also adding some more open bars, which is more positive. We added some X's and we took out the triple bottom breakdown signal that had been generated to no signal at all right now. So that's an improvement with the point and figure chart. We're back to positive with the Elder, with the SPY and the SPX. I said that reverse. SAR, this is another kind of biggie right now. You notice where the little dots on the bottom? This chart has now switched over to positive. We're getting back, and it might be a little hard to see. Right where I'm circling, that's more of a pale purple right now. That's more of a negative neutral reading for the go, no-go system. Long term, we're still extended with our 50, 150, and 200-day moving averages, but we are showing some improvement. Special K just continues to go down and down. It's going to need to see a lot more than what's already happened. The Dow, or the diamonds here, that switched back to positive, and we were able to get above this pivot level with the Dow. And the Qs have switched back to positive. They're right about on the pivot level right now. We want to watch the Nasdaq and the Nasdaq 100. If we really get some serious upward movement, that's where it's really going to come from. And this bar is a lot smaller than what we're seeing for some of the other indexes. Can we stay above this pivot level and continue to go higher? If we start to break down, we'll probably see this fall down from this pivot level. The Vixen continues to decline with the up days that we've been seeing. Here's the Nasdaq, also just a little bit above the pivot level with a lot smaller bar. Mid caps, this is a lot bigger bar here, where we did get quite a bit above the current pivot level. We have some resistance at a previous pivot level right now. The Wilshire also above the pivot level. So you can see where some improvement is happening here. The dollar continues to have some weakness. It closed down at 109.98. It's back up in after hours right now, but it's still in an overall uptrend. And the British pound, after really tanking last week, it's continuing to show some improvement. And if we see more improvement, I'm probably going to take this chart off, since that seems to be old news now. The S&P to the dollar still having a pretty good tendency to go in opposite directions. Gold came right up to the 50-period moving average and closed right at that level, but we're still in an overall downtrend. I mean, you got all the gold people really hot and bothered right now. They're really liking what they see, and they're just sure that this is the beginning of something great, which might be true, but they also thought this was the beginning of something great, and that this was the beginning of something great, that this was the beginning. I mean, yeah, okay. If you use precious metals and try to work with them on a trending basis, that can be very frustrating. Also, silver was up pretty strong too, and people are starting to take notice of that. We're seeing the 50-period moving average starting to turn up, but it's still in an overall downtrend. Oil is starting to go back up, and that is kind of feeding through to the gas pumps as well. We're at 86.52 right now. And the S&P to oil also having a tendency to go in the same overall direction. Looking at bonds, seeing some improvement, but we're going to need to see some more here with the total bond ETF showing some improvement with our world bond index as well after going extreme. As bond prices have been going up, the 10-year yield has been coming down. It's at 3.617 right now. The 30-year has also been coming down a little bit. Stocks and bonds are still having a tendency to go in the same direction. Bonds have been going up and stocks have been going up. If this correlation can continue and we can get some favorable economic conditions that last more than just a few days, this could be quite positive for the market, because if bonds go up, interest rates come down, and if stocks go up, that helps lock in some capital gains. Also, here's the yield curves: 10 to the 5, 10 to the 2, 30 to the 5, and we're just not going inverted yet as far as the 10 to the 3 month. The tech sector to the 10-year also having a tendency to go in opposite directions. Yields have really been coming down over the last couple of days across the board, but you still have the blue one here. That's the 2-year yield. That's still giving you the best return. Our scenarios, our charts are showing improvement, where the 19-day exponential moving average, it continues to show some bouncing based on price and volume. And again, when we see extreme negative readings, a lot of times that provides support to the S&P. The same thing can be said of the 200-day simple moving average study. After going almost extreme, it is showing some improvement. 50-period moving average also showing improvement with the S&P, the mid caps, and the small caps. The 10-day average of the highs minus the lows, it's not really bouncing up yet. It's still extreme negative. And I pointed this out yesterday. We're seeing price start to change, but we're not seeing a lot of internal strength, at least compared to the highs and lows. We're seeing a contraction of the new lows, but we're not seeing an increase in the new highs, because we're bouncing around at price levels where we've been at before, not so long ago. Looking at the broad market, though, we are seeing some improvement with the Amex, Nasdaq, and NYSE 5-period high-low moving average. So, and again, sometimes when this gets extreme, that gives some support to the S&P. Our equity put call ratio over 5 periods continues to decline. So now we're still working off of this spike. When this does spike like this, that often gives support to the S&P. I know I sound like a broken record, but the reason I'm doing that is because we're seeing a continuation of the convergence of a lot of signals coming together at the same time. And now, at least over the last 2 days, we're starting to see this play out. We just want to know, can it continue? Small caps also had a really good day, up 3.8% and closed above the pivot. And the ratio between the small caps and the S&P is showing some improvement. So this is giving a little bit of life to this chart. When we see this little spike up on the red chart, that's the small cap to S&P 500 ratio, that often gives support to the blue chart, which is the S&P by itself. The S&P to the 10-year also tending to go in opposite directions. We're not seeing real improvement, though, with our sector rotation. The Qs continue to decline. Discretionary blipped up a little bit. Large cap growth against large cap value still not doing all that well. The chart that's looking the best right now are the small caps. That continues to advance, where the mid caps didn't really improve and the large caps didn't really show any improvement in Tuesday's session. The S&P to the 2-year still having a tendency to go in the opposite direction. And so with the 2-year coming down, is this going to be a spike? It's still pretty early to tell that. This is also encouraging with the S&P to utilities ratio. Utilities have been really getting hit as the S&P has been going up. And so this is showing some improvement. And if you look at bottoms here, that often gave some support to the S&P. Just like when we spiked out to the upside, that often marked some kind of a top in the S&P 500. Staples were up, but not that much. So we're seeing our spike really coming back down. So this right now is looking more viable. And this, to me, is one of the stronger signals. But we've been whipsawed so many times in 2022. It looks like we're getting a spike only to have it taken out by other spikes, even after it spends a considerable amount of time declining. This is the one extra thing. And I'm not saying this is what's going to happen. I was just looking at all the charts like I do every day. I thought, okay, we're looking a little bit extended in the short term. So number one, we might be short-term overbought. Okay, not a lot of our indicators are saying that, but we have a few that are. So what would happen if we had a slight pullback, just sideways to maybe down, but not a real rip-roaring down day? If we have a real strong down day, it probably blows this little scenario out of the water, because we're seeing some other charts that might confirm things, even if we see a little bit more weakness. So let me explain what I'm talking about. Here's the mass index. See how we were getting close to a signal, and the signal that is not generated until we get above the blue line. Well, with the last up days, this is starting to turn down. Well, if we can have a little bit more weakness, just some not real too bad weakness in the S&P, that might turn this up and get it above the blue line. Then we could start to go up, and then it crosses down below the red line, and then that's an official signal. This is a two-part indicator. That could, because the mass index doesn't tell us what direction. It tends to be leaning to the side that it's going up as the market has been coming down. We want to see, will that continue? So what if we get a little bit of weakness and see this turn back up slightly? Now, it may not do that. It may recalculate and blow this whole thing out. It's just what I'm noticing right now. Another chart is the Copic curve. As we've been going up, we're getting a really extreme reading with this now, and it's starting to turn back up as the S&P is going up. If we could see not too much of a down day right now, and possibly a little more to the upside, this has the potential of crossing above this moving average. Again, this is another signal that doesn't tell us the direction. We have to use other tools to figure out what that is. But it looks like it's responding more to the upward movement right now. So, but we're not there yet with this signal. If we see a little bit of a pullback to sideways move, it might still help this to cross the moving average. And now we have some more confirmations. That's just the scenario. It might be worth as much as an old newspaper. I don't know. I just saw this as I was looking through the charts, and so I wanted to present that to you just for something to watch out for. So what's in our outlook for Wednesday? The technicals are negative, but improving. Many of them are still oversold, with some short-term ones actually already overbought. Of course, now we want to know, can it continue? Remember, we're also at that very short-term fib resistance level. We have the MBA mortgage applications index, and that comes out every week. We have the ADP employment change coming out, and we have trade balance. And we have the final IHS market services PMI This is the big one, the last one, the ISM non-manufacturing. We got the ISM manufacturing. Now we're going to get the non-manufacturing index, and that could be the one that really helps set the tone for the day. We got the whole list of geopolitical events that I'm not going to go through again right now. The big one for the market, as I say every day now, inflation and interest rates, which are producing growth concerns. All right, so what are our scenarios? We still have to go with down. Things are still pointed in the down direction, but we can't really look at that confidently because the technicals are negative, but we're showing some overbought signals, which might push us down a little bit. But we still have a lot of intermediate term and long-term indicators that are trying to rebound from being oversold. We can't really go with the up scenario yet for pretty much the same reasons. But our possible, and why can't I say that? The possible positive scenarios, they are improving. And then there's that other little short-term scenario that I mentioned right here at the end. I don't know if that'll be anything or not. It may be just a waste, but who knows? But the technicals, they need a lot more follow through to really improve. And we got to get back to some moving averages. We're not even close yet. Sideways, yeah, the ADX is weakening, but it's still above 20. We don't really take that a little bit more seriously until it drops below the moving average. And with the red line on top, it is still negative. So our conclusion, the S&P is negative, rebounding from being oversold and improving. Short term, it's bouncing with some overbought signals already. Intermediate term, bouncing and showing some improvement. Long term, we're still negative with, I didn't show the chart, but we're still pretty extreme with that rate of change going back 200 days. So thank you. I hope this is helpful to you. Please have a very good day, and I'll prepare the next video after Wednesday's session.